Imagine trying to climb a steep, jagged cliff with absolutely no safety rope. One wrong step, and it is game over. It sounds reckless, right? Well, in the financial markets, trading without protection is exactly the same thing. This chart represents the price of a stock over time. You are the climber starting at the bottom, and your goal is to reach the peak for a profit. But the market is unpredictable. Sometimes the ground just drops out right beneath you. If you do not have a safety mechanism in place when that cop happens, you fall all the way to the bottom. In trading terms, that means your entire account balance can easily go straight to zero. That is where a stop loss comes in. A stop loss is simply an automated instruction you give your broker to sell your stock if the price falls to a certain level. Think of it as a climber who hammers an anchor into the cliffside. If the market suddenly turns against you and begins to drop, you fall a short distance before that rope instantly catches you. You automatically exit the trade, taking a controlled loss. Instead of suffering a total financial wipeout, you take a minor scrape. You preserve enough of your money so you can step back, dust yourself off, and climb again tomorrow. If a stop loss is such an essential tool, you might be wondering why so many new traders completely refuse to use them. It usually comes down to one incredibly frustrating experience. You buy a stock, set your safety anchor, and the price drops just enough to hit it. You get ejected from the trade for a small loss, and then immediately after, the price turns around and rockets straight up to your profit target without you. It feels terrible to watch, but enduring a few of those annoying bump outs is just the cost of doing business. It is mathematically so much better to get knocked out of a few good trades than to endure one massive drop that empties your bank account. The good news is you can dramatically reduce those frustrating fakeouts. It all comes down to exactly where you choose to place that safety anchor in the first place. First, you want to avoid round psychological numbers. If you buy a stock and place your stop loss exactly at $1,000, you are asking for trouble. Markets naturally gravitate toward these clean numbers, making them slippery, highly unstable spots where an anchor simply will not hold. You also want to avoid placing your anchor exactly on an obvious flat ledge, what traders call a support level. Prices often wobble, and the market routinely dips slightly below these obvious ledges, just to grab a little extra momentum before bouncing right back up. To survive that normal market noise, you need to tuck your safety net safely beneath the lowest point of those jagged drops. You give the trade room to breathe, so everyday price wobbles do not accidentally trigger your exit. And as a quick rule of thumb, it is wise to avoid starting a new climb right when massive news is breaking. When the market is reacting to big announcements, the swings are so huge that they will knock you off the mountain no matter where you put your anchor. Proper placement is about finding the sweet spot. You secure your safety net, but you keep it just far enough away that the normal, everyday tremors of the market don't artificially trigger your exit. Now, let's talk about the best part, what to do when your trade goes exactly right. When the price rises, you start moving high above your original starting point. This is where we use the no-loss strategy. Your anchor doesn't have to stay at the bottom. As you climb safely, you manually adjust your stop loss, pulling your anchor up to match your initial starting price. This creates a pure break-even point. Think about the math. If the market suddenly crashes from its high peak and triggers your stop loss right where you started, you walk away with zero profit, but crucially, you also walk away with absolutely zero loss. As the stock climbs higher, you pull that anchor up, locking it above your starting line. If the market suddenly plummets, your safety rope catches you high above where you started. You exit automatically and still get paid. At the end of the day, successful trading is not about perfectly predicting the highest peak. It is about systematically removing risk from the equation and pulling your safety net up with you so that even when you are eventually wrong, your money is perfectly protected.